Just one more reason you should use Vanguard over any of the other fund companies. Oh my God, this is sick. And I say that in a cool millennial hipster way. It's sick. This is awesome. Man, Vanguard, kudos to you, my friends. You guys, my man Randy from Seattle sent me this link from a Bloomberg article, which is just insanely fantastic. And let's read it. And of course, all the naysayers are up in arms that Vanguard is helping their investors shield from paying taxes, avoid taxes. Not avoid paying taxes, you're following the law, for heaven's sake. But anyway, Bloomberg, Dateline Bloomberg, and I don't know who that lady is. Bloomberg, right here, May 1st, 2019, from Zach, Annie, and Christopher. All right, so the headline, Vanguard patented a way to avoid taxes on mutual funds. And just be advised, this patent is still good through 2023. Randy, you're the man for sending this to me. My friends, if you find articles like this, I love this stuff. So let's read this and just bow down in awe of the behemoth that is Vanguard and the good that they're doing for the average investors. And I can just see those people at Fidelity, at corporation headquarters saying, why did we think of this? Because you're not thinking about your shareholders, man. Not like Vanguard is. Vanguard's doing this to benefit the shareholders. All these other firms are thinking about how they can raise the bottom line. Vanguard is thinking, how can we raise the bottom line for our owners, which are the shareholders, the people who own Vanguard funds. Fidelity is owned by the Johnson family. Schwab is owned by public corporations. They're all thinking, how can we make the bottom line better for those people? Nothing inherently wrong with that. That's the whole difference between Vanguard. It's it's almost like what's a socialistic place here? Employees, not employee stock ownership. It's literally the owners are the consumers of the products, which is freaking awesome. I just chuckle at socialistic because socialistic. I was listening to this podcast the other guy. was like, socialistic, the owners are on the farm. And I was like, employee stock ownership, they own the firm through capitalism. All right, anyway, like flipping a light switch, Vanguard Group has figured out a way to shut off taxes in its mutual funds. The first to benefit was a Vanguard's total stock market index fund. Investors' end-of-the-year tax forms abruptly stopped showing capital gains in 2001. Man, it's so funny because I've been looking at all that. I said, where are the capital gain distributions? I knew the ETFs, they don't, and we'll go into that deeper here. But I said, how come the VTSMX isn't showing any capital gain distributions? Even as the fund went on to generate billions of dollars of capital gains, it did not pay capital gain distributions. By 2011, Vanguard had flipped a switch in 14 stock funds. In all, these funds have booked $191 billion in gains while reporting zero to the IRS. Hallelujah! Hallelujah! This outstanding success gives Vanguard funds an edge over competitors. My friends, if someone is telling you to buy other than Vanguard funds in a taxable account, you just got to say, why? Why would we do that? I mean, literally, for the next 4 years, I do not understand how any other account could be Vanguard when they have this patented system here. Yet the world's second largest asset manager has avoided drawing attention to it. Oh man, my nose. Remember I got my surgery. Ouch, that hurt. I just had to breathe in. Ouch. Top executives at the Malvern, Pennsylvania firm don't want U.S. policymakers looking too closely at how they're doing it. According to a former insider. See, I hate that crap. Affording insider. Who's this guy? You can say I'm a former insider because I used to work at Vanguard. So according to Josh Scanlon, former insider, but a review of financial statements and trading data shows that Vanguard relies substantially on so-called heartbeat trades, which wash away taxes by rapidly pumping stocks in and out of a fund. These controversial transactions, where's the link for that? Hold on a second. I want to see what the link for that controversial thing. I got my other computer up here. What's the controversial? Bloomberg. This article is from a Bloomberg article dated. The ETF tax dodge is Wall Street's dirty little secret by pretty much the same people here. It doesn't have a dateline on this, but anyway, so they're using the same thing about the ETF where they're basically doing in-kind transfers to avoid capital gains. Now, what's wrong with that? I mean, literally. The whole issue about mutual funds is that you're tax inefficient. What's wrong with making tax more efficiently? It's not like you're avoiding them. I mean, you're not. Let's see. But only Vanguard has used them. Only Vanguard has used these transactions routinely to benefit mutual funds. Yep, because firms can do it to benefit with their ETFs, exchange traded funds, but only Vanguard has used it to benefit their own mutual funds. Again, because they're looking out for their shareholders. Why aren't these other firms doing it? Here's how it works. Vanguard attaches a more tax-efficient ETF to an existing mutual fund. Then the ETF siphons appreciated stocks out of the mutual fund without incurring taxes, often using heartbeat trades. Robert Gordon, who has written about the concept and is president of 21st Securities Corp., calls it a tax dialysis machine. Rapidly pumping money in and out of exchange trade portion of the Vanguard Small Cap Index Fund removes taxable gains for the benefits of the shareholders because the index funds would have to report capital gains on transactions where they receive a gain because all that money has got to be distributed to the shareholders because ETFs are closed-ended essentially because you buy them on the public market. They only issue a certain amount of shares. When you're buying and selling, there's a different tax scenario set up for ETFs than mutual funds because of that. So again, it's exchange, basic, not like kind of transfers. There's a terminology I'm drawing a blank on, but they're exchanging fund for fund, which means it's a non-taxable event. In a mutual fund, they're literally selling stuff. It's a taxable event. So Vanguard is actually saying, we're not going to sell. We're just going to do a like kind of exchange to the ETFs, which is friggin' awesome. So right here, yeah, this chart beginning in 2017, outflows, stress. I don't know what this blue means. So I'm not sure what that. We got inflows and out. I don't get what this blue and red mean. Anyway, let's keep going. Vanguard even got a patent on the design, valid until 2023, so competitors can't copy it. Rich Powers, the head, Vanguard's head of ETF product manager, acknowledged the design's tax advantages. But he said in an interview that they're not the driver of the company's strategy and that all trading complies with the law. We agree that Vanguard funds have been extremely tax efficient, enabling us to provide higher after-tax returns to our shareholders and better their chances of achieving long-term investment success. Yep. Although the dialysis treatment shut off the capital gains in the 14 stock funds, it didn't completely neutralize them in a separate real estate index fund, which invests in trusts that aren't taxed like stocks. All right, so taxable gains be gone. Unlike competitors that follow similar indexes, Vanguard mutual funds stopped saddling investors with taxable gains once the ETF share classes were added. So here's the Vanguard's total stock market fund. There's taxable gains. Let's see. Yeah, here it goes. It goes back to 1994. 94 tax. Yeah, see that? I'm telling you, man. I noticed that. I was like, why is there no taxable gains? Here's Fidelity Total Market Index. Here's the Vanguard Wilshire 500 Index Fund. And here's the total. Well, I don't know if that's whatever Wilshire 500 5000 Index Fund. That'd be the Vanguard, I guess. Whatever. Here's the Vanguard Fund. Here's the Fidelity Fund. In 2001, they haven't paid a capital gain distribution since 2001. Man, that is freaking insane. Here's Fidelity. Here's Fidelity. Here's Fidelity. I mean, inherently, you'd want to own the Vanguard Fund. There's just no other way around that. Small Cap Index Fund. 2001 stopped. Here's Schwab. Here's iShares. I mean, you're seeing it for yourself. Dreyfus. I mean, look at this Federated Mid Cap Fund. I mean, they're paying capital gains every year. It's Vanguard. They stop. I can almost assure you my performance will be better than all these funds after taxes. It's not even close. The main benefit, and here's where the article gets it wrong, the main benefit of avoiding taxable gains in a mutual fund is tax deferral. Funds distribute their taxable gains to investors who pay income taxes on them in the same year. By avoiding tax events within the fund, investors get to delay taxes until they sell the fund, which could be years or decades later. Now, what they're missing here is they don't just get to delay until they sell the fund or until they die. All right, so again, if you have tax efficiency, Vanguard funds are absolutely the way to go on your taxable account. This is going to change my whole bucket approach in terms of what you should have and what kind of account. I always say dividend accounts in your Roth and small cap growth oriented stuff in your taxable because there's not much capital gain distributions or dividends. Well, if you can have Vanguard funds, mutual funds, which are not showing capital gain distributions and minimize dividends, that's going to change. This just changes everything. It's akin to a zero interest loan from the IRS. The stakes for the U.S. That's water, by the way. The stakes for the U.S. Treasury are significant. While heartbeats already help eliminate taxable gain distributions in the $3 trillion U.S. equity ETF industry, the mutual fund market is more than 3 times as big. When Vanguard's patent expires 4 years from now, other fund managers may have the chance to build their own dialysis machines. Yeah, but then they got to replace them with ETFs, which is what Vanguard has done. They've added ETFs to the mutual funds. Does Dreyfus have an ETF they're going to add to a mutual fund? I mean, is that just relevant? I mean, who cares? To understand how the process works, consider an investor who owns a portfolio of stocks. If one is sold for more than what it costs, capital gains is due on the difference. Theoretically, owning stocks through a mutual fund or ETF works the same way. If the fund sells a stock for a profit, the taxable gain shows up on each investor's end of the year 1099. But thanks to an obscure loophole in the tax code, ETFs almost always avoiding incurring taxable gains. Thus, ETFs are always preferable to mutual funds, unless it's a Vanguard mutual funds, apparently, which is cool. The rule says that a fund can avoid recognizing taxable gains on appreciated stock if the shares are used to pay off a withdrawing investor. The rule applies to both ETFs and mutual funds, but mutual funds really take advantage of it because their investors almost always want cash. ETFs use it all the time because they don't transact directly with the regular investors. Instead, they deal with Wall Street middlemen such as banks and market makers. It's those firms, not retail investors, that expand the ETF by depositing assets or shrink it by withdrawing. These transactions are usually done with stocks rather than cash. The middlemen in turn trade with regular investors who want to buy and sell the shares. Trading with middlemen presents ETFs a tax-cutting opportunity. Whenever one of these firms makes a withdrawal request, the ETF can deliver its oldest, most appreciated stocks, and one is most likely to generate a tax bill someday. If the ETF wants to cut its taxes further, it can generate extra withdrawals just to harvest the tax break. A heartbeat is when an ETF asks a friendly bank or market maker to deposit some stock in the fund for a day or two, then take different stock out. Some critics call those trades an abuse of the tax code. Anytime there's someone who's doing what he can under the tax law to minimize taxes, is always an abuse. It's never an abuse, man. The tax code is so damn complex, you can't blame people for trying to maximize their fiduciary responsibility to maximize returns for their investors. But with the help of heartbeats, most stock ETFs, even ones that change holdings frequently, are able to cut their capital gain taxes to zero. Customer-owned Vanguard, founded by Bogle, built a reputation for low fees and tax efficiency by offering simple buy and hold funds, index funds. It has about $5 trillion with a T in assets. In 2000, after Bogle had stepped down as chief executive officer, he didn't step down, they forced him out. I was there. The firm unveiled a novel strategy to enter the ETF business, a market dominated by SSG at that State Street, State Street and iShares, which is now part of BlackRock. Rather than establish new freestanding ETFs, Vanguard proposed to add an ETF share class to existing mutual funds. ETF and mutual fund investors would jointly own the same underlying pool of stocks. The concept made sense for Vanguard. Investors who preferred ETFs could easily convert without selling, and the Vanguard ETFs would have a head start in the marketplace. They'd be able to point to decades of performance history and benefit from the existing mutual fund scale and ensuring low fees. To keep competitors from copying the deal, Vanguard filed a plan with the U.S. Patent Office in 2000. Jeez. Vanguard funds have made more use of heartbeat trades than any other ETF manager. Look at this, $130 billion. BlackRock is next, and I think these are the largest fund manager, if I'm not mistaken. I mean, look at this. Just Vanguard. Taxes weren't a big part of the investor pitch. In fact, some observers thought taxes were a drawback to Vanguard's plan. Investors expect ETFs to be more tax efficient than mutual funds. Why buy an ETF if it might get burdened with the tax bills of a sister mutual fund? The fund will exhibit little of the ETF's characteristic tax efficiency, said one skeptical consultant in 2004. In hindsight, it's clear as those fears were misplaced. So one skeptic, one consultant, they're always got negative Nellies out there. Rather than getting dragged into tax abyss, the ETFs lifted up their sister mutual funds. Once an ETF share class was added to a mutual fund, capital gain distributions fell to zero, while non-taxable gains from stock withdrawals shot up. So years before, okay, so these charts are hard to follow. Okay, taxable, okay, there you go. Yeah, so here's the taxable gain distributions before the ETF creation, and here's the after the ETF creation, the non-taxable gain distributions. That's freaking crazy. Although dialysis machine has attracted little notice outside Vanguard, it has been controversial within the firm, according to two people with knowledge of the matter. Some employees have raised questions whether it's appropriate to use ETF to wipe away capital gains built up years earlier in mutual funds. What I can share with you is we feel comfortable with our approach to portfolio managers, said the spoke guy. Let's see. So they're saying Vanguard trading Monsanto showed the dialysis machine in action. The agrochemical giant had agreed to be sold to a German rival for $56 billion in cash, and the Vanguard stock index was one of Monsanto's biggest shareholders. It had owned shares since the early 1990s, and over those decades, the stock had risen more than 25-fold. That meant Vanguard probably faced a big taxable gain. On June 4th, an unidentified investor pumped $1 billion into the fund's ETF. $1 billion. 2 days later, when Monsanto was scheduled to exit the index, the same investor took $1 billion out. It looked like a classic heartbeat trade, except it was 5 times too big. The ETF portion of the fund had only $184 million of Monsanto to get rid of, and no other large stock was leaving the index that day. The size of the deal makes sense, though, considering that the entire fund had $1.3 billion of Monsanto to unload. The ETF didn't just dispose of his old small stake in the company; it got rid of the most of the mutual funds as well. I mean, that doesn't bother me. Tax goes stupid. I mean, I hate to say it. Thanks to winning on stocks like Monsanto, the fund reported $6.5 billion of capital gains in 2018. But for the 17th straight year since it got an ETF share class, the fund distributed no taxable gain to investors. It's a beautiful thing, my friends. The ETF ensured the vast majority of the gains, $6.549 billion, were not taxable. The balance was probably canceled out by tax losses from earlier years. There are dozens of similar examples in Vanguard's ETFs. Oh, man. In some funds, heartbeats are so large and frequent they outweigh regular stock withdrawals. The Vanguard Small Cap Index had about $37 billion of stock withdrawals over the past 7 years, about 20 of which were from heartbeats. I just love it. All right, we'll say, let's keep going down here. Van Eck, USAA license. Look at this. Vanguard has discussed licensing its hybrid ETF mutual fund design to other firms, but no deals come to fruition. USAA licensed the patent but never used it. What? And Van Eck Associates once sought regulatory approval for a similar design. USA licensed a patent but never used it? What patent? The one Phil Back, CEO of Exponential ETFs, said he expects other firms to mimic the Vanguard model once the patent expires. If you want to operate both vehicles, you want to transfer some of the tax advantages of an ETF into mutual funds, a very efficient way to do it. Mario Gabelli of Gamco Investors said he's on call for ending ETF's tax advantage over mutual funds. Vanguard may have found a way to level the playing field by using heartbeats, but he's not tempted to copy it. You're going against the intent of the system and finding ways to manipulate. No, you're not. It's not good for confidence. Come on, Mario. This guy's a rich guy. He's the competition is Vanguard is putting him in his dust. But I'm saying it's not good for confidence in capital markets because the tax goes so jacked up that Vanguard took advantage of it. Why should Mario Gabelli's mutual fund, when it trades activity in the mutual fund that creates a capital gain in said mutual fund for 2018, send that capital gain to Grandma Jones has now $40,000 of capital gains, some of which are short and some of which are long. And she did nothing. All she did was buy the fund in 1996. She did nothing other than keep the fund. In 2018, she was down 5% for the year. But because Mario Gabelli and like-minded cohorts like that who are actively trading, they send these capital gains, these 1099 fund distributions, to unsuspecting shareholders who have to pay the tax, who did nothing other than buy and hold. So why should they bear the brunt because Mario Gabelli and these other guys don't like getting their socks handed to them by Vanguard? That's what happens. It's not Mario Gabelli so much that's bearing the brunt of this. It's Grandma Jones and all these other middle-class investors who are getting these 1099s at the end of the year saying, what's going on? I'm down 5%. Why do I got a $15,000 long-term capital gain I got to pay tax on? Because that's the tax code. I'm sorry for manipulating that insanely stupid tax code for the benefit of Grandma Jones. Screw that. That's the way to go. And shame on these other guys for not, shame on USA for having this and not doing it. So kudos to Vanguard for taking the bull by the horns and freaking saying, this doesn't make any sense. So, hey, if that's what it takes to get the freaking regulators to say, enough of this 1099 freaking long-term, short-term capital gain distributions when you just did nothing but buy and hold a share, why should you pay the taxes, Grandma Jones, for a quick trading activity of some freaking day trader in a mutual fund? It doesn't make any sense, and yet it happens all the time. That's not the tax code the way it's supposed to be. Anyway, good stuff, my man Randy. Thanks for sending this out. This stuff like this fires me up. And again, kudos to Vanguard for doing this. I love it. I wish USA, they had the patent, but they never use it. I will see you.